Welcome, everybody. This is episode 5 of The Grow. I am your host, Scott Sinclair, and this week we will review 2 different methods cannabis companies are using to pause, shake the box, and prepare for future success. We are now episode 5, as I said, and therefore you all know the plan. The Grow podcast is about business fundamentals applied to the business of cannabis. It's about leadership, management, about controlling the things that you can control. It's about making money, improving cash flow, restructuring fundamentals, raising capital, creating shareholder value, and realizing or monetizing on that value. This episode, as always so far, is brought to you by Sinclair Range. Link in the notes. Sinclair Range helps all businesses, including cannabis businesses, raise capital, turn around operations, restructure debts, and generally execute on all the strategies that we discuss on this podcast. Go out and check Sinclair Range. Again, link in the notes, sinclairrange.com, and reach out to us to discuss with no obligation, no fees, just to have a conversation. Let's discuss your specific situation and how Sinclair Range can help. I know this is April 22 when you are hearing this podcast, but I am running the notes on April 20th, and I would like to say to you, happy 420 vibes. Yeah, happy 420 from the Grow podcast. To everyone growing the plant, building the brand, shaping the future of cannabis. This 420, we're celebrating the resilience of an industry that refuses to quit. From seed to sale, it's been a grind, but the passion is still burning within you. To the entrepreneurs, legacy operators, scientists, and retail bud tenders, thank you for making this the industry that it is. You are the roots of this movement, and you've made it this far in the cannabis industry, and therefore you've made it through the challenges, pivots, and constant reinvention, and so you have earned, therefore, this celebration. So congrats to you. Speaking of resilience, let's look at how Tilray Brands is trying to reset and stay in the game. Bloomberg reports that cannabis company Tilray Brands is proposing a reverse stock split for its shares, otherwise known as a consolidation. Let's stick with the term reverse stock split. Tilray Chairman, Chief Executive Irwin Simon says the reverse split would better align Tilray's number of shares outstanding with companies of its size and scope, while a higher price per share would ensure compliance with Nasdaq's continued listing requirements. So we're going to talk about a reverse split here. We're going to talk about shaking the box generally on this episode, and which means sort of changing the playing field so that you can move forward with success, which sometimes you just need to do when things are not working for you or your business. But let's not kid ourselves. This reverse split is about getting the stock above $1 so it doesn't lose its listing on Nasdaq, which is valuable and they think is important to their business. So right now, Tilray stock is trading at 45 cents a share, and it needs to be $1. So if you were to do a 1-for-10 reverse split of the stock, instead of 45 cents, theoretically, it would be $4.50 a share, well above the $1, except it won't because you never keep your market cap when you do a reverse split. You're going to lose 20 to 40 probably percent of the value of the stock just by doing the reverse split for no fundamental valuation reason. It's just that people don't like to sell at 45 cents a share, but they might sell at $4.50 a share, even though it's the exact same number because the number of shares are reduced. Currently, Tilray has 997 million shares outstanding, almost 1 billion shares outstanding. It has a float of 990 million shares, almost a billion share float. What is the difference between shares outstanding and a float? Shares outstanding are the number of shares that the corporation, the corporate body, in this case Tilray Brands, has issued ever in its history to anybody, unless those shares have been canceled. But let's assume there were none canceled. So it's all the shares that have ever been issued to an insider, to an employee, in an IPO, to anybody. It doesn't include secondary trades. If I bought some stock from Tilray directly, then I sold them to you. That's a secondary trade. But it's just all the shares that Tilray has issued in this case, which is a billion more or less shares. And that's what's outstanding. But what is a float? Well, a float is the amount of shares that are available to be traded in the public market at any given time. In other words, they're not restricted, they don't have legends on the stock, they're not tied up in a control block that no one's ever going to sell. These are actually the shares that sell into the market. Tilray has 990 million shares in its float. And that, my friends, is a very important number if you're in investor relations or you want to promote a stock and get the stock price up. Let's say, hypothetically, for example, you go through an investor relations blitz, you do all the marketing and the social media and the conferences, and you go to brokers' offices and you do pitches and roadshow stuff, and you manage to generate demand for 1 million or 2 million shares. Well, that's awesome. You've done a good job, except you have 990 million shares that can sell against you. You're probably not going to move the needle at all. I can tell you, if you're in the stock promotion business, you pay a lot of attention to the float and you manage the float very carefully for that very reason. I'm not saying that that's what should be done in your company or in any company in particular. I'm not here to promote stock promotions. I'm just telling you the size of the float is a huge issue if you're into trying to create market value for your company. The market cap of Tilray is 448 million. That's in US dollars. And they're trading right now, as I said, as I did this, about 44 cents, 45 cents a share on the Nasdaq. And it dropped about 5 cents since the release that said they're going to do the reverse split, which it should. It should drop, as I said, 20 to 40%. I would certainly be getting out. I do not give you financial advice, by the way. I'm not trying to tell you what to do with your investments. That's not the point of this podcast or any of the content that I do. But it's dropped about 5%. Is that related to the announcement? Well, we don't know. It was dropping heavily before the announcement as well. So the announcement says that Tilray will be asking its shareholders to approve a plan to do a reverse stock split where you take 10 common shares and turn them into 1 common share. So that's called a 10-for-1 reverse stock, or maybe a 1-for-20 reverse stock split. So I'll give you, you give me 20, I give you 1, right? 1 for 10 or 1 for 20. And it says they'll figure out, they'll get the approval from shareholders, and then they'll decide whether it's 1 for 10 or 1 for 20 or somewhere in between. Well, again, the purpose of this is to get the stock price up to be able to qualify for the Nasdaq listing at 45 cents. Nasdaq's going to call you, maybe they already have, and said, hey, we're going to kick you off because your stock price is too low. And you say, no, give us 6 months, and we're going to go to shareholders. We're going to do this reverse stock split, and we will, get our stock price up. And if you're trading at 45 cents, if you do a 1 for 10 reverse stock split, well, theoretically, you're going to be, as I said before, $4.50 less whatever you lose along the way, and you definitely will lose some. Also, so that's why they're doing it, to stay on the Nasdaq. But also, as I said, they have 1 billion shares outstanding and basically in the float, which is an unmanageable number from an IR stock promotion perspective. Tilray, think about it, could double its market cap, more than double, to $1 billion, and there's still a $1 share price, given where they are right now. They have about 1 billion shares outstanding. If the market cap is $1 billion, that's $1 per share. Its market cap would have to grow tenfold to $5 billion before they're no longer a penny stock, which would be defined as $5 a share. So it's just a huge, insurmountable wall of stock outstanding that if you think about having to manage the public currency side of your business being your stock, as I've told you, you should on this Grow podcast, that you should treat that really as a separate business from your core business of creating intrinsic value. Well, you just can't do that with 1 billion shares outstanding trading at 45 cents. You do the reverse split, if you had that $1 billion market cap, you could get your stock to a $10 or $20 a share, depending on the amount of the reverse split, which is a more respectable number. You just can't trade as a penny stock and create a bunch of value. It's not going to work. Also, as I said, it reduces the float. And you want your float, if you're in that IR stock promotion world, you probably want your float to be somewhere in the 6 million to 8 million share range. And if you did a 10 for 1 or 1 for 10 on this stock, you would be down to the 10 million share range. Is that right? No, it's not even close. It's still way too much. It'd be 100 million. It's still way too many shares. There's just way too many shares outstanding on this company, but it definitely helps the float issue. The move by Tilray provides more evidence that goes along with the thesis of this Grow podcast that the public structure, one of the things that we've been talking about, that the public structure is simply not working for most cannabis companies. You don't have enough market cap. There's barely any cannabis companies. Barely, there are some, but there's very few cannabis companies in the world that have enough market cap to justify the fees and the problems of a public listing. I have suggested to you, you should be going private. If you're insolvent, you should be going private through an insolvency proceeding. But if you're not going to do that, as Tilray is clearly not going to do, you should look at what Tilray is doing. They're shaking the box. They're resetting their capital structure by looking at a reverse split, and that is probably a very good move. Let's move on. Mernova Medicinal Inc. Mernova Medicinal Inc. and Creso. No, that's not true. Creso, C-R-E-S-O, Canada Limited, not to be confused with Cresco, on which we did an episode before. If you go back into our limited short and supply of archives, you will find we talked about Cresco. But these are Nova Scotia-based cannabis companies. On April 16th, filed CCAA. That's the Company Creditor Arrangement Act in Canada, very similar to a Chapter 11 insolvency restructuring in the U.S. And I took a lot of this from the affidavit of the CEO for Mernova, and she's also the sole director of Cresco. So the corporate structure here I took from the affidavit. If you got Mernova, which is wholly owned by Cresco, so you got Creso, I keep putting a C in there. Creso wholly owns Mernova, and Creso in turn is wholly owned by Melodiol, M-E-L-O-D-I-O-L, Melodiol, something like that, which is an Australian corporation, which in turn went bankrupt, used to trade on the Australian Stock Exchange. And so the bottom line here is that the Canadian operations are owned by an insolvent Australian company, and there's guarantees in Australia, and the Canadian company is going to get called on those guarantees, and it just can't manage that. It has hit a wall, and it needs to shake the box. It needs to reset the deck. How many analogies can I throw at this so that it can then carry forward? Says from her affidavit, Mernova has suffered a significant financial loss as a result of a variety of pressures affecting the cannabis industry, including stop me if you've heard this before, competition and oversupply, operating costs associated with a regulatory regime, the requirement to obtain significant capital to successfully develop and generate revenues from new products. She's been on the treadmill of new products, apparently. Decreasing investor confidence in the cannabis industry and the high cost of excise duties for cannabis products issued by CRA. That is the Canada Revenue Agency. But mostly, its parent company went bankrupt, and the guarantees are there are guarantees, intercompany guarantees, and the Canadian company is therefore insolvent, and it needs to restructure. The company's primary secured creditors, La Plata, L-A, second word, Plata, P-L-A-T-A, Capital, LLC, which I believe, don't hold me to this, but I believe is a Colorado first secured and otherwise bridge lender, is owed $6.6 million, that would be Canadian dollars, and Bryant Nominees, which is owed $2.9 million, again Canadian dollars, and that Bryant, B-R-I-A-N-T Nominees is an Australian-based distributor, as near as I can tell. So that would be a strategic loan, whereas La Plata would be a financial loan. And those are two different things. Perhaps we will talk about those on future episodes, the nature of those two types of loans. And they've both issued demands under the respective loan agreements, and they are supportive of the company running a SISP, S-I-S-P, a sales investment solicitation process. So as a reminder, CCAA Chapter 11, what does it do? It stays everything. You got guarantees being called in Australia, puts a stop to it. You got lenders demanding, puts a stop to it. You've got CRA coming after you, government, everything just, you go to the bankruptcy court and the judge says, okay, everybody that's coming after you, all the litigations, it just comes to a stop right now. Everybody take a breather. let's try to figure out how we can move forward with this business and try to save jobs. That's what you're doing in a CCAA. The CCAA process, the Chapter 11 process, often facilitates or permits what's called a DIP loan, which is a lender coming in and just primes everybody, jumps on top, and gives you working capital to go through the restructuring and to do the things that you need to do. That is available to you even in the cannabis industry. And someone pointed out to me, hey, regulatory blah, 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 you can't do DIP loans. Not true. Not true. You can do DIP loans. They are available to you. Reach out, talk to Sinclair Range if you want to do that. The CCAA Chapter 11 allows you to restructure debts with the court assistance. So, okay, I owe you $100. So what I'm going to do is I'm going to pay you 10 cents on the dollar, and the judge is going to say, I don't owe you this 90 cents anymore, or I'm going to pay you 50 cents on the dollar, but I'm going to do it over 5 years, or 100 cents on the dollar is going to be converted to equity or whatever. There's some sort of restructuring that is part of this process. And maybe you sell the business, which is a sales investment solicitation process. Because how do you sell a business? If you have a troubled cannabis company that's insolvent, you can't pay all your debt, how do you sell that to me without me taking over all your liability problems, which I don't want? Well, the answer is you file this process and you do a SIS, sales investment solicitation process. And at the end of the day, the judge gives you what's called a vesting order. And it says, hey, purchaser, you got all the assets and none of the liabilities. You're good to go. You owe nobody anything. And that makes your business sellable, whereas it wasn't saleable before. So there you go. 2 examples from this week's news cycle of ways to shake the box and change things up, reset your business to be successful. We talked about a reverse stock split with Tilray, and we talked about a CCAA restructuring. Both of those are thinking outside the box, so to speak. Again, confusing all of my analogies and metaphors to think outside the box so that you can make your business reset and able to move forward. All right, that's it for this week. Wherever you listen to podcasts, please go there, subscribe, like, participate, reach out. What things do you want me to talk about? Do you know any guests that I should bring on? I want to bring guests on. Let's do that. I will talk to you next week. Thank you for listening. This has been The Grow.